All right, good morning. Let's get started. My goal today isn't just to teach you a set of tools, but to really install a new mindset. See, to make it here, you have to become what I call a warrior poet, someone who masters both the art of valuation and the cold, hard science of data. This is the challenge, and today is day one.
You've all heard this quote from Buffett. It's the thread that connects everything we do. And don't think for a second it only applies to value investors. It's just as true for a disciplined quant who trusts their model even when the market is screaming. You see, patience. That's the common ground between both worlds.
So what's our job here? Let's be crystal clear about this. We're a fund of funds. We don't build the black boxes ourselves. Our mission, our edge, is to be the absolute best in the world at understanding and picking them. And that all starts with this one crucial idea. We are not looking for genius. We are looking for resilience.
Okay, so to really get inside these funds, you first have to understand the powerful story they tell the world. This is the narrative, the image that pulls in billions of dollars in capital. Let's break that down.
The public story, it really boils down to three pillars. First, there's the whole technological supremacy angle. You know, the idea that AI and a mountain of servers have made human fund managers obsolete. Second, they'll tell you they serve a vital market function, that they're the good guys, providing stability. And third, they pitch themselves as long-term partners, totally aligned with their investors.
And look, this is way more than just slick marketing. These claims are backed by enormous, tangible investments. I mean, when a fund like Highflyer goes out and builds its own supercomputer, it takes an abstract idea like we use AI and turns it into a very real, very expensive moat that's incredibly hard for anyone else to cross.
So that's the story they tell. But our job, our real job, is to look past that narrative to the reality on the ground. And in this case, we're talking about a unique battlefield, one with very specific dangers that your standard off-the-shelf models just weren't built for. The single biggest risk you need to understand in China's A-share market is something we call the liquidity cliff. And let me be clear, this is not some rare black swan event. It's a structural feature. The system is literally designed in a way that allows all liquidity to just vanish in the blink of an eye.
And this table, this shows you exactly why those Western models so often fail here. The A-share market is just a fundamentally different animal. It's driven by retail emotion, not institutional logic. And it's caged by hard rules, like those daily price limits and T+1 settlement. All of this creates unique dangers, like overnight gaps and those terrifying liquidity cliffs.
Listen, anyone can look good in a bull market. A smooth track record tells you almost nothing. A manager's true quality, the real strength of their process, that's only revealed in a crisis. It's when things are on fire, that's when you see what they're truly made of.
Let's take a perfect example from early 2024, the so-called microcap factor. It was an incredibly popular, very profitable trade for a long time. And then it just suddenly and violently collapsed. This kicked off a chain reaction of forced selling among the very quant funds that had been piling into it.
So what happened? Well, it was a classic, a tale as old as time, the overcrowded trade. You had way too many funds all chasing the same alpha, all exposed to the exact same risk. And when the music stopped, they all tried to squeeze to the same tiny exit at once. It turned into a stampede.
Now, this is where it gets interesting. The managers who navigated this storm weren't the ones with the smartest alpha models. Nope. They were the ones whose risk models stopped them from chasing those returns in the first place. They had already budgeted their risk. They capped their exposure to this crowded trade before the crisis hit. That's discipline.
Now here's a totally different kind of failure. Picture this. It's the first trading day after the Lunar New Year. The market is already fragile. Everyone's on edge. And one firm's algorithm just unloads over 2.5 billion RMB of sell orders in the first minute of trading. Think about that.
This was a textbook execution failure. The model, simply put, was blind. It had no ability to sense the market. It was just trying to execute its own orders in a vacuum, completely oblivious to the massive impact it was having on an already weakened system. It became the very source of the volatility it should have been trying to avoid.
So, all of this brings us to the most important question. If the public story about Genius AI isn't the whole picture, then what is the real competitive advantage for these top funds? What are we actually buying when we allocate to them?
Look, it's not about some mythical alpha model that predicts the future. The real, verifiable strength, the stuff that's been battle-tested, is in their process, their discipline, and most importantly, their survival-first risk models. The pitch is all offense.
The reality is all about defense.
The best firms, they operate on a model we call rules-wrapped optimization. Think of it like this. At the center, you've got this powerful math engine. That's the part that's always hunting for returns. But it's wrapped in a thick layer of armor. And that armor is a set of hard-coded, non-negotiable survival rules that were learned the hard way. Rules like, you never ever trade at the price limit. This armor puts survival above everything else.
So, in the end, don't let them sell you on the mystery of the black box. They aren't selling you magic. They're selling you an armored vehicle, one that's been custom designed for a very hostile and unpredictable battlefield. That proven resilience, that is the most compelling value proposition they have.
Okay, I'm going to leave you with your first real test. It's a thought experiment. You have two choices. Manager A has a stunning track record, a Sharp of 2.5, but their process is a total black box. Manager B has a solid but less flashy record, a Sharp of 1.5, but they give you full transparency and a risk plan you can actually verify. Who do you give the capital to? And more importantly, how do you stand in front of the investment committee and defend that choice? The answer you come up with, that's going to tell me if you are really listening today. This is the foundation of your career. Now get to work.